You know, since the beginning of time, the unwashed masses have been blamed for every economic catastrophe, including the infamous tulip bubble described in Charles Mackay's classic Extraordinary Popular Delusions and the Madness of Crowds. Now, this line of thinking is especially prevalent in the stock market, where the pros on Wall Street constantly remind everyone of the risk of individual optimism. Yet year after year, professional fund managers come up short and few beat the returns of the market, hence this surge in passive investing. The question is whether there is wisdom in the crowds. I would say so. You know, recently individual investor sentiment seems to have been spot on. On December 27th, investor bearishness crossed above 50%, but it's come down to a very much benign level, 29% since. Meanwhile, bullishness surged to 38%, coinciding with one of the fastest 10% rallies in the history of the stock market. Now, when a lot of people are packed into a theater on the opening night of a highly anticipated movie, there's an air of excitement and opportunity and even a willingness to suspend disbelief. Now, if someone in the theater screams fire and sets off a stampede, then that crowd really becomes more akin to a mob driven by fear, real or imagined. So really the moral of the story here is that the wisdom of the crowds exists. It's the madness of the mobs that are distinctly different things. Moreover, you know, these crowds, think about this, they ultimately decide the winners in the market as consumers. Now, for that reason, I happen to believe that communication services are going to be your big winner in 2019. Joining me now to discuss, Eddie Ghabour. He's co-owner of the Key Advisor Group. Eddie, you know, it's so interesting because I see Wall Street always saying, oh, man, everyone's optimistic, get out, everyone's pessimistic, get in. I'm a little bit more afraid, to be quite frank with you, of Wall Street than I am of individual investors.
Yeah, absolutely. I mean, it's like you have this Monday morning quarterback. When you look at what happened in the fourth quarter, you thought the world was coming to an end. And then after Christmas Eve, we start to see a rally. Now, all of a sudden, everything is good. I think as the individual investor, the key is just not to make emotional decisions financially, because that usually ends up to bite you in the rear end.
Yeah, the problem, I think, though, is that there's so much information. You pick up your smartphone, you turn on the television. It's just coming at you a million miles a minute, and when the chorus is negative. You know, again, I talk about the reason I use the analogy of a theater. When people are sitting there ready for the curtain to come up, they're excited. If someone comes out, the usher, and says, hey, there's a fire in the back, we all panic. But the ushers are the professionals.
Yeah, you know, it's kind of like the old adage that bad news sells. It seems like when you see these small market drops or corrections that, by the way, are absolutely normal in a secular bull market, which I believe we are in a secular bull market, they seem to overhype the downside but not on the upside. And some individual investors get scared and panic because, to your point, I agree 100%, this 24-hour media can hurt individual investors when things are bad and all you read is bad news, bad news. Sometimes you can be forced to make an emotional decision that's not in their best interest.
I want to talk about the crowds as consumers. They ultimately decide what companies do well, what products do well. I think for that reason, communication services where you do have Netflix, where you do have Facebook, where you do have Google, where you do have electronic arts, where you do have Twitter, I think that's going to be the group that really leads this market this year. What do you like this year, and what do you think of my thoughts there?
I absolutely agree with you 100% in regards to that. I also actually like the financials, the big banks right now. You look at their valuations, they're really inexpensive, and couple that with the fact that temporarily at least, with the Fed not raising rates, I think we've avoided an inverted yield curve that have hurt these banks. So I think banks have an opportunity, if the Fed stays pat, to really be one of the leaders, because they have not really participated like many other sectors last year and the year before. So I think this year could potentially be the good year for these big banks.
All right. Any particular ones you like more than others?
I do, of course. I like Citigroup as one. I like JP Morgan. You look at both of those.
Right.
Of course, it depends on the investor's risk tolerance, but they both pay a dividend over 3%. And again, I think they're priced relatively cheap.
Eddie, great talking to you. We'll see you again real soon. Thanks.
Thank you for having me.